Good morning from the ENCA Money Desk. Now, despite high interest rates, South Africans are still taking out more and more credit. And this is according to TransUnion's second quarter reports. Now, last week, SARB Governor Lesetja Kganyago announced the repurchase rate will be left unchanged at 8.25%. The prime lending rate is at 11.75%. And credit mostly comes at a much higher rate than that. For more on this, let's speak to Weihan Sun from TransUnion Africa. Weihan, thank you so much for joining us this morning. Let's look at the numbers. With more than 775,000 new clothing accounts that were opened in the second quarter of this year.
Yeah, Melissa. Clothing accounts we've seen continue to grow as a result of, we actually had one of the coldest winters in South Africa. And if you couple that with load shedding, the demand for clothes obviously rose as a result. And that's in line with what South Africa has published, that in the retail sector, clothing, footwear, and textiles will continue to grow, whereas some of the other retailers obviously have come down from a revenue point of view. And if you look at the annual reports from many of these retailers, they're also saying that they're seeing a continued growth in terms of sales of retail goods. But where is that sale coming from? As you pointed out earlier, majority of those sales are now starting to come from credit bookings, as opposed to primarily what we've seen traditionally being a cash-based society.
Now, so more and more people are looking for credit. We can understand that in the current cost of living crisis that we are experiencing. But your research also shows that credit limits for these accounts have also risen quite a bit. Is this credit limits from people already existing clients? Is this new credit limits? Just tell us a bit more about that.
Okay, Melissa, from a limit increase point of view, we're obviously seeing more limit increase extended to existing consumers who have whether a credit card, retail revolving, or clothing accounts. And that's because they have a demonstrated record of credits on the lender's books. What we're seeing on the new originations, on the new accounts that's being originated, we're actually seeing the opposite, where lenders are more cautious in extending higher limits. But they are still meeting the demand by actually offering those accounts to consumers.
If we go back to clothing accounts, nearly 1/3 of these accounts are overdue, and that is quite concerning.
Absolutely. The 1/3 ratio has been pretty consistent since even before the pandemic. We're actually seeing a decrease at the current rate compared to those pre-pandemic periods. But from a year-on-year perspective, we also saw a slight improvement, but quarter-on-quarter, we did see that deterioration. And that's obviously due to the fact that, we still, in the quarter 2 period, still operating in a very high inflationary environment with petrol prices being very high. So most of consumers' liquidity is actually being directed to paying off basic goods rather than, some of their obligations. So that high ratio that you're seeing, although it has traditionally been at similar rates, is pretty standard at the current times.
If we look now to personal loans, there's also been a noticeable increase there, and especially those from micro lenders. What are the amounts we're talking about here, and how big is this?
So generally speaking, when we look at personal loans, we separate them into bank and non-bank providers. And in the non-bank elements, general average loan amounts are around 5,000. For the bank personal loans, generally the amounts are around the upper band of 30,000. So there's a big difference between the two lender types and the types of credits they're offering, as well as the type of consumers they're servicing. In the non-bank segments, the risk of consumers are generally higher. Therefore, they do offer lower amounts in that state. But the volume of accounts being originated in that segment is much higher at the current share of the market. What we're seeing is lenders from the banking segment on the personal side have actually restricted the amounts of loans they're offering, not from the sense that they're being more careful from the type of risk they are actually taking onto their books, because the personal loan segments, very similar to the clothing accounts vertical, is also experiencing high levels of defaults and delinquencies.
Let's look at some good news, and that is that some people are trying to pay back home loans faster amid this high interest rate environment.
Yeah, so when we look at the home loans market, generally speaking, in the South African home loans market, you're seeing much less risky consumers, and generally what we classify them as super prime consumers. So a bulk of the home loan providers who are highly affluent or have higher income, they have the capacity or additional liquidity to actually repay some of that principal amounts on their home loans to maybe alleviate some of the constraints caused by the interest rates. So when we're seeing the upper band, so higher income, more affluent consumers paying down probably the principal of their home loans, the other side of the spectrum is consumers with lower income may be suffering the most in terms of their home loan obligations. We've had 10 interest rate hikes over the past 2 years from November 2021. So that has eaten and tipped in many of these consumers into delinquency. But what we've seen is obviously in more recent times that the MPC have kept the rates unchanged for 2 consecutive months. The issue with that is even though no further increases have happened, we're still at a 14-year high from an interest rate point of view. So that's continuously eating into the wallet of many of these consumers. So if you're highly affluent, most likely you have the ability to repay some of those things. And it's probably more encouraging to do so because the home loan repayment generally at a month end is the highest outlay from a consumer's wallet. With the lower income consumers, it is advisable to probably engage with those lenders and maybe structure a different repayment arrangement and maybe alleviate some of that strain for these consumers.
Thank you so much for your time. That was Weihan Sun. He is the Director of Research and Consulting at TransUnion Africa.